What's up, everyone? It's Cowdy with Money Vesting. So, markets here very much back and forth. They were red, they were gapping down quite a bit intraday, and then we saw a lot of momentum back up for the S&P, for the Nasdaq, for the Dow. All three closing in green, with the Nasdaq up 73 basis points, the Dow with the strongest rally up over 1%, and the S&P 500 also pushing higher, back up to 39.81. So, it looks like the bulls really took us past the 200 simple moving average despite the 10-year yield is pushing past 4%. So I'm going to talk about the debt ceiling in this video. We'll talk a little bit about the credit markets, the bond yields, the spreads, volatility, and of course, individual stocks and the Nasdaq and the S&P and the Dow Jones as well. So always, if you guys enjoyed this video, find it helpful, don't forget to hit that like button and of course, subscribe if you're joining us for the first time. And the link to our Discord and Patreon is going to be down below. I did share some trade ideas with all the members, which I will be going over in this video later. So first things first, let's talk about the debt ceiling. So debt ceiling was first initiated in the United States government back in 1917. It is a statutory limit, and it's pretty much set forth by Congress, right? So this is a limit that pretty much tells the government how much they can actually borrow and how much they can spend, right? So obviously, every time the US government kind of taps onto that ceiling, they can no longer borrow, right? So they can either do spending cuts or they can default on their obligations. And neither of those scenarios are obviously good for the US. Now, the United States has technically defaulted in the past, like they were delayed in some payments back in 1979. But again, it's not an official defaultment. It's just a technical default from the United States. And of course, despite the past events, the United States is still considered as one of the best credit-worthy countries that is going to pay up on their debt obligations. But once again, it is an issue that is resurfacing. And because of those reasons, the cost to protect against a U.S. government default has once again skyrocketed. Like the credit default swaps have pretty much gone up to the same levels we have seen from back in 2013. And you can see that we are up to 67.97 for the 1-year US credit default swaps. And these are the same levels that we saw back in 2013, 2011. So once again, the government, the White House can't figure things out. And we are in this showdown once again with the debt ceiling sitting roughly at a little bit, I think, under $29 trillion. If you think about it, it's absolutely nuts. But of course, the United States does spend a lot of money, and that's why they're in a fiscal deficit every single year, and the ever-growing debt levels as well. So we are once again at these levels, and this is again another chart representing how there's been very, very close calls with the debt ceiling, and a default would absolutely be catastrophic for not only the U.S. economy, but for the world economy as well, because they will definitely get a re-rating on their credit worthiness, and thereby not a lot of demand for their bonds and treasury bills and T-notes and all that stuff, right? That's bottom line economics 101. That's how the United States raises money, by selling government bonds, right? And they have to pay coupons on those bonds. And the interest alone, I think this year in 2023 for the United States will be over $1 trillion. And it is growing at a much faster clip, considering the higher yields, higher interest rates, right, on those bonds, and not to mention the higher debt levels to begin with. So because of that, they have to make sure that they are consistently reservicing that debt. So they are issuing new debt and paying off the old ones. And because of how much it's grown, there's obviously a lot of debate, a lot of speculation, a lot of concerns that in the future, there might be a time where the US may default on their debt. Obviously, it's never happened before. Like I said, in 1979, it was a technical default because they just kind of delayed some of those payments. They didn't completely shut off payments. They just delayed them. But right now, credit default swaps are once again back higher. And there's been a survey that's been done. Voters most likely to blame both parties equally if government defaults on its debt. And blaming both parties was literally 37%, 32%, among Democrats, 53% independents, 32% Republicans, but 37% was the majority for the blame in the United States for defaulting on the national debt. Powell is sounding the alarm. This actually came out just a couple days ago and is sounding the alarm on the debt limit again. And Fed Chair reprises warning about no option but to hike limit. And it's quite interesting that Jerome Powell kind of refrains himself from all fiscal policy debate. Every time there's been questions about fiscal policy, he tends to not answer them, but he's very vocal about the debt limit and raising it because obviously it makes his job a lot easier. Now, this right here is going to be the trade idea that I shared on Google. So shared about it a few days ago, and the entry was a little bit under $90, and Google had a really good day today, so pushing higher on the day, up a little bit over 92.31, up almost 2%, and really starting to push back above into that green zone and that profitable area, and our target's up to $100. So again, if you want to get access to these swing trade ideas, again, I'm not going to be sharing every single day. Every time there is an opportunity, I will be sharing some trade ideas. So you don't expect me to share like every single day, every single week some trade ideas, but I can guarantee you that every time I do share a trade idea, it is going to be well-researched, well-thorough idea with the highest success rate possible, right? The win rate is going to be higher. So it's more quality trades over quantity. So if that's something that you are interested in, the link's going to be down below for our Discord if you want to join. And these are my Tesla covered calls. I know I've been getting a lot of questions about the updates on them. They're trading at 330 per contract, and right now I'm up a little bit over 75%. Usually, most of the times, I'd be closing out these calls in a pretty much a hot second. But because I rolled these calls out earlier, I was sitting at 225 or closer to 230, I think. And then I rolled these calls out in the middle of February. My threshold for profitability is a lot higher. So I'm looking at least 90%, if not more, for profitability. And, right now up a little bit over $3,000 in the last 2 weeks, but I'll be looking at a lot more, probably closer to $4,000 if I can with these calls. And then I will be closing them out for a profit because I rolled those out. So still receive the net credit, but if I do end up buying to close right now, I would pretty much break even on this trade, and I don't want to. So that's something that I wanted to share. Now, going over to the markets now, the 10-year yield, pretty much all yields. This is what's driving the market right now. Everything that you see in the markets, this is what's being driving it. That's the 10-year yields. It's a bond market. And unfortunately, right now, the stock market is completely defying what the reality of the situation really is. With the 10-year yields pushing as high as they are, we're still not seeing any type of a pullback, any type of concern, any type of fear in the markets, which is quite concerning in itself, because obviously with the markets pushing higher back up, we're back above that 200 simple moving average, getting a very nice buyers to step in. Volume was decent. We're back up to 39.81. And the 10-year yields were higher. So the 10-year yields were up to 4.05%. We're almost up to 4.1%. The high was 4.069. The 1 year is sitting at over 5%, almost at 5.1%. And we got the 6 months sitting at 5.2. These are pretty high yields. And as a result, yields go higher in a high inflationary environment. The P multiple should not be, at least not in my opinion, be anything over 16 to 17 times earnings. Even that seems to be a bit of a stretch. And right now we're again trading in the 17, 18 times earnings, 19 times earnings seems pretty normal for the market, which, again, I'm kind of questioning the market sentiment here, questioning the market's momentum back to the upside every time we do get those dips. Now, Fed funds futures, we're once again back down to pricing 75 basis points. It's probably because Raphael Bostic's talk and speech about 25 basis points, and he'd be more dovish, but he is a non-voting member, so really doesn't matter what he says. He could put some influence on the voting members, but at the end of the day, it really doesn't matter what his thoughts or opinions are. No offense. But this right here, 75 basis points, is where we are right now over the next 3 meetings, and then no cuts priced in from the markets. Up until yesterday, there were some cuts priced in. Now there's none, and about the probability for us to get up to 6% has dropped down to 10.1 to 11.3%. Motor vehicle sales coming in just a little bit shy of 15 million. Consensus was 15 million, so just a little bit slowdown in that. And Tesla here is still down 6%. That was one of the reasons why the covered calls were higher so much. Nvidia continues to charge higher. AMD was up 2.75% because an activist hedge fund took a passive stake in AMD. We'll talk about that shortly. Google up 2%, Microsoft up almost 2%, Apple pushing higher. Banks were down substantially as, of course, interest rates continue to push higher, which should benefit banks, but it's also going to drop off on some of the loan activity and the volume of those loans. So banks here were red, but everything else pushing higher. Healthcare was also slightly down. And this right here, the entire state of the market. Utilities were up, the best performing sector, despite the yields pushing higher. We got communication services, materials, technology, defense, and real estate, industrial. So most sectors were up except for financials. And over the last 1 week, we got basic materials, energy, industrials pushing higher with everything else selling off. And over the last 1 month, most sectors are down for the S&P 500. So natural gas, volatility, silver, all pushing higher. Orange juice definitely coming down pretty aggressively with coffee, cocoa, and cotton. And the big sell-off in cryptos, right? Bitcoin here down over 5.5%, trading down to low 22,000s. And Ethereum also now trading under 1,600 at the moment. This right here is another really interesting chart that I've already done a video on, shared in the past. This is the 20-day weighted moving average on the equity only put call ratio. And right now it is once again at close to a sell signal as of March 2023. And the last few times we got these extreme levels were back in April and August. And you'll notice that the markets did decline quite a bit. So from April, we pretty much saw this right here as a sell-off. In August, this right here was the selling pressure. Both instances, we kind of hit a new low. And right now, the markets are once again trading sideways. A little bit of a pullback right now, but we are still at an extreme level in March of 2023 when it comes to the equity put call ratio. Not to mention that somebody's already placed a big bet on volatility calls all the way up to 50 by May. So activist hedge fund manager Dan Loeb takes a passive stake in AMD. So that again was the reason why the AMD stock was pushing higher. So the hedge fund manager took a bet when AMD shares struggled, according to sources. AMD shares have underperformed the rest of the sector over the last 12 months, down more than 30%, as the semiconductor index is down 14% as well. Now moving over to the markets here, volatility once again coming down, absolutely getting crushed down a little bit over 4.8%. But the fact that it's trading at such low levels increases the probability of a higher call volumes because of how low it already is, and it acts as a hedge for potential spike in the volatility and the markets coming down. So it doesn't necessarily mean that, if the call volume on the VIX is higher, that doesn't mean that VIX is absolutely going to spike and the markets are going to come down. No, it actually means the reality is that people are taking that as a hedge, considering two different things. Number one, VIX is already at such a low level, right? We're trading at 18, 19, 18, 19. We're like at that level for such a long time. And those days of 25, 35 volatility are long gone, right? So if we get a huge spike in the volatility, those calls are going to print like crazy. Number two, the premiums on these calls are going to be very, very cheap, right? So because of the fact that VIX is not higher and it's not going any higher, we're seeing probably premiums to be a lot lower. So it makes for a perfect hedge, right? A hedge is nothing but an asymmetric bet that you're taking on, like an insurance policy, right? You're okay with losing that amount, but instead, if it works out, if your hedge is right, you can end up making a lot of money, right? That's what a hedge is really all about. Think about it for Tesla hedge, right? I literally had to do nothing, but instead sell covered calls on it. It was free. I instead received premiums for it. And if Tesla stock rallies, great, I'll make money on the long side. If Tesla stock drops, great, I'll make money on the short side. So that's what a hedge is. It's an insurance policy. It doesn't necessarily mean that the markets are going to absolutely behave in that manner, but it's just like a potential short hedge that investors, institutional funds, hedge funds are taking on. So volatility still down a little bit under 20. We'll keep a close eye at this 20 levels, and the next support really is going to be down to 17.7 all the way down to 14 levels. I do expect as volatility continues to come down, call volumes continue to rise and open interest will increase over the next few months, 30 days, 60 days out, 90 days out. Call options on these volatility calls are going to be through the roof, in my opinion. Oil prices, once again, consolidating sideways, a little bit under $78 per barrel. So we have, for the most part, consolidated sideways here. Next resistance, you guys know, at low $81 per barrel. Support level is going to stay put, roughly at around $76 per barrel. Hey, my undo key is working again. So Ethereum with a big drop. This right here was the big resistance that we talked about for Ethereum. So right now we are getting rejected at that level. Not a surprise. And Bitcoin also getting a big rejection here at 25,000. We started to roll right back down, and 22,400 is going to be that support level to watch for Bitcoin moving forward. Now, the 10-year yields, 4.05%. We've talked about the 10-year yields in more detail and how it's been pushing higher. And this is the technical chart where we have broken out of that range of that previous resistance. And the next level to really be paying attention to is going to be 4.25%. And that is pretty much going to be the next area of resistance for us to watch. And I've got a big trade idea video coming out for all the members on long duration bonds and going long on them, considering how much yields are pushing higher. And in my opinion, it's just not sustainable for the yields to keep pushing up like this. They could get up to 4.4, 4.5%, even as much as 5% if inflation doesn't come down and interest rates keep pushing higher from the Federal Reserve standpoint. It's possible, but I will be sharing some trade ideas for long duration bonds. And I think there's going to be a lot of opportunity in that sector, in that particular area of the market. So we'll be doing a private video for members later today or tomorrow to share that idea, because we still have got time, right? It's not like we have to take that trade right away. We still have time. We can be patient as the yields keep pushing higher. Now, talking about the S&P 500, lots of buyers stepping in at that 200 simple moving average. We talked about this during our live stream. So once again, we're seeing a little bit of an RSI and a MACD push higher. One of the things that I mentioned in our Discord yesterday was the fact that a short-term bounce is not unlikely considering how oversold we were from a short-term perspective, right? So if you come over to this chart, which is S&P 500 stocks above 20-day moving average, and again, a lot of our members in Discord can vouch for this. I shared this chart specifically after yesterday's market update and talked about how we were close to around 82% back in the first week of February. So February 1st, February 2nd, we were at 80%. And then look what happened, right? This metric dropped 84% in February alone, right? So that means the percentage of stocks that were trading above their 20-day moving average went from 80% down to 17%. Now, this does suggest that a short-term bounce is a possibility, which is one of the reasons why I shared a long trade idea on Google and Vertex. But that doesn't change the fact that the longer-term thesis or the longer-term perspective and the macro and the unresolved with inflation interest rates are still not going to be a problem later down the year, right? So this is more of a tradable environment and tradable market considering a short-term bounce. From an investing standpoint, sure, you can look at individual stocks and dollar cost average, but we have to be mindful of what's actually going on in the economy with respect to the macros, with respect to interest rates and the time lag. Most importantly, it's the impact lag that we talked about in my yesterday's video, which is yet to be be affected, right? Which is yet to play a role in the markets moving forward. So that being said, we are seeing a little bit of a bounce back up in the S&P, in the NASDAQ. We're seeing a momentum back up. Lots of buyers stepping in at the 200 simple moving average. So very, very nice move back up. And the next resistance, really is going to be at 4,100. We'll see if, 4,000 is a psychological level, but 4,100 is going to be that resistance in line with that 300 SMA. And of course, in line with this previous resistance where we have gotten rejected at in the past in 2022. Same thing with the NASDAQ. So we are seeing a little bit of a momentum back up. So green candle here, very strong green candle. The volume was also really good. And the next resistance is going to stay put right over here. That's going to be sitting roughly at around 12,280. So this right here is going to be that level to watch for the NASDAQ moving forward. Talking about Apple here, and Apple on the day, also seeing some buyers to step in, although we have seen a bit of a pullback here. So Apple is still down 8% from its recent highs. We've got that 200 SMA sitting roughly at 146. So that right there is going to be that level to watch and support all the way down to $137 per share. My fair value obviously a lot lower in the 120s for Apple. And our side MACD has been coming down, so it's not a surprise that we are seeing a bit of a pullback, but buyers stepping in on the day, which I do think is going to be temporary in nature, in my opinion. Talking about Amazon on the day, Amazon also seeing some buyers to step in from low 90s. It was trading as low as low 90s here, and then the buyers stepping right back in. We do have a potential trade idea, but I would feel like a better entry would be closer to $81, $82. But then there's the risk of whether Amazon actually gets down there or not. You can potentially take a trade idea here. Just make sure that you're mindful of your stop losses and your risk management. And the profit target is going to be all the way up to $102, $103, even as much as $104 per share for Amazon moving forward. Talking about Tesla here, Tesla green candle on a red day, so lots of buyers stepping in, and Tesla, of course, we know there's a lot of momentum, there's a lot of euphoria, there's a lot of sentiment behind this stock, and 182 is going to be that support level to watch right now. We got down to as low as 186, and Tesla at one point was down over 8%, so lots of momentum to the downside, but support level is going to stay put at $179, $180, and the resistance next is going to be in line with that red rectangle, sitting roughly at $213 per share for Tesla. Talking about NVIDIA continues to charge higher, so there's no shame in NVIDIA left. I feel like it's just getting more and more overvalued without any any cares given in the world. I want to use a different word, but this right here is going to be that support now, $230, and of course we're starting to have a very strong green candle. The volume was very decent. The volume is actually not that great, 39 million shares versus the average volume 52 million, and we haven't quite filled this gap yet entirely. We did come down a little bit, but it can still come down and fill this gap quite a bit. Support level all the way down to $190, but we're back above $230 here for NVIDIA. Talking about advanced micro devices, and after hours, looks like it was only down about 0.5%, but on the day pushing up 2.75%, back up to $80 per share. So we're back above that 200 simple moving average. Lots of back and forth, lots of consolidation for advanced micro devices. But this right here is going to be that support, and that's the gap that we're talking about for AMD, right? So that's this very small gap that it needs to come down and fill in. All the way down to $71, $72 is going to be that next support level to watch. Talking a little bit about PayPal, and PayPal on the day was also higher, 0.38%, but very, very small gap filled here. We still have a support sitting roughly in the low 70s and a resistance staying put at $75. So that right there is going to be that resistance. Support level is going to stay put in the low 70s. And of course, we got a fair value sitting roughly at around $70, which I think is going to be very reasonable for PayPal. Trades at a good value, trades at some good growth sort of potential here. Resistance 75 all the way up to that 200 simple moving average at $82 per share. Talking about Square now starting to finally break apart from this downtrend. So lower highs and lower lows consistently selling off. And now we're starting to see a little bit of momentum back up. And the next resistance all the way up to 89, close to $90, in line with that 300 simple moving average and that resistance that we've also talked about in our previous videos. Talking a little bit about Meta now, and Meta on the day was slightly higher, 0.64%. So lots of consolidation, just pretty much going sideways. The markets in general have been very much in an uncertain, indecisive mode where we are, for the most part, trading sideways. We did pull back a little bit, and now some buyers are stepping in. But on a net basis, I feel like there's been a lot of consolidation for a lot of individual stocks, right? We've just been trading and just kind of drifting sideways for a lot of individual stocks, such as Meta. Really hasn't moved anywhere since the beginning of February. Right now, we're pushing back up. Resistance is going to stay at $183. We got a big gap to fill on the downside as well. Netflix on the day slightly down, and Netflix has definitely seen a lot of selling pressure, in the last few weeks here. Resistance is going to stay put at $329, and next support all the way down to $276 for Netflix. So that right there is going to be that next support level. RSI and MACD are coming down. So eventually this will also provide us with a potential long opportunity as a swing trading idea. We'll definitely take advantage of that in the future if and when it comes down to low 270s. 275 would be ideal for Netflix for a potential swing trade on the long side. Talking about Google, we have already gone over, so very nice move back up. RSI MACD makes a lot of sense. Next target and resistance all the way up to $99.97, closer to $100 per share for Google. And finally, we got Microsoft here, also getting pushed up almost 2%, back up to 251. Support level getting validated here at close to 245, 246 for Microsoft. And we got that 200 simple moving average sitting roughly at 251. And last but not least, we got Shopify, and Shopify on the day also pushing higher, 2.6%, getting a little bit of a retest at that rejection or resistance area at close to $41. And we've got a huge gap to fill here. Oversold RSI and MACD, so there is potential for Shopify to also get bought up. And that's the bottom line, right? So S&P 500, NASDAQ on a short-term basis definitely do seem a little bit oversold. And, considering this chart over here that I showed you guys earlier, there is possibility that we do see a little bit of momentum back up for stocks to be back above their 20-day moving average, but we have to keep that long-term perspective in sight and understand the macros are still unresolved. There's uncertainty with inflation and interest rates, so that could still lead to a potential recession, which could lead to lower earnings, which could lead to lower prices for the markets. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. And if you want to get access to all the trade ideas, buy and sell alerts, options alerts, private videos, member videos, all that stuff, link's going to be down below for our Discord. We'll be happy to have you on board. We've got over 3,600 members part of our Discord. So link's going to be down below. As always, happy investing, and I'll see you all in the next video.